Okay, as promised, restarted the video. All right, next thing. I found this reading on all these topics here very interesting and also really hard to get my head around. It took a while to make sense of all these things. And one of the things they were pointing out was people's probability judgments are not attached to an event. They're attached to descriptions of events. How likely are the Cowboys to win? There is no, in nature, a likelihood. There is no possibility that the Cowboys will or won't win. They're either going to win or they're not going to win. All right, so in nature, there is no probability. Probabilities are a function of our imaginations about the events. All right, events don't have likelihoods. A likelihood is an opinion. It is not an objective value. Opinion is based only on the information available to the decision maker. Not only on the information, but also on the framing of that information. So, as I get that, oh, that's right. There wasn't a likelihood that Napoleon would win the Battle of Waterloo. Either he won or he didn't. A likelihood is the opinion of those studying the battle and considering various factors, and it's based on the information you've got, plus on the framing of that information. And then, this is a really interesting one down here. There are very powerful incentives to follow the crowd. And let's say that you are a fund manager in the 1990s when the stock market was increasing by this ridiculous rate of a 20% in real terms for 5 consecutive years. And the conventional wisdom is, well, it's going to keep going up. This is a heck of a market. It's never going to turn down. As opposed to, yeah, I think this is building up to a bust. That it's going to collapse. Now, let's say that you decide to go with the conventional logic. You go with the market's still going to keep booming like this, and you tell all your customers, you invest in what you're going to invest in for your customers. That is all the .com stocks that are going sky high, and you turn out to be right. Well, you're very rational. That was a very good decision to make in the 1990s to buy .com stocks that are skyrocketing. Good for you. You went with the conventional logic. You were right. Very rational thing to do. You went with the conventional logic. You were wrong. Well, you just got unlucky. Who would have known? Who could have known? I don't know if you can remember this far back, but there was a Super Bowl when the Patriots got beat by the Giants. And did that happen twice? I can't remember now. But anyway, the one where David Tyree catches a football on his helmet and the Giants go on to win. A big upset. And if you had bet on the Patriots, and ignore the fact that there's also a point spread, but if you had bet on the Patriots to win and you were right, well, you're rational because everyone thought they were going to win. If you bet on them and you were wrong, well, who would have known? That was bad luck. So notice that the column here is unlucky or rational. You either get credit or you get dispensation. On this column down here, I don't know. I don't think we should be buying any of these .com stocks anymore. And you were right. Yeah, you got lucky. Versus you were wrong, you're an idiot. So everything else being equal, you're always better. Unlike what your parents told you, you're always better doing what everyone else says to do. Because if you're right, you're rational. If you're wrong, you're unlucky. But if you go against conventional wisdom, the best you can hope for is lucky. Now, obviously, if you continue to be successful, that may change that. But, if you're a fund manager back in the 90s and you think it's going to collapse at some point, you want to keep your job? You do this. You want to take a big risk? You do this. Okay. All right. Now, on top of those psychological factors that I just went over with the representativeness of representativeness, anchoring, availability, and then the framing and so forth, Keynes made some specific observations about the stock market rather, in the general theory. And the first one was about uncertainty. And you already know a lot more about uncertainty than most people do. But he's only pointing out one little narrow thing about uncertainty here. He's only pointing out one little narrow thing here, and not the usual thing we talked about with all the dice. He's saying, when we don't have much information at all, the information we do have plays a disproportionate role in our forecasts. I used to give this example to class, and apparently I still am because I'm about to. Back in the old days, when I was in college, you would fill out a little piece of paper for what classes you wanted to take. It was a thing they would run in the computer afterwards, but you couldn't do it yourself because there were no such thing as PCs and so forth. And then you would stand in line and you would turn this sheet of paper in to somebody who would then later type it up or transfer that information to the main computer where they could arrange everybody's classes. So let's say you're standing in line and you just started the TCU and you're going to take an intro micro class. And you hear somebody say, "Hey, I hear Dr. Becker hardly ever fails anybody," which was true. That was Dr. Becker back when he was teaching at TCU. And you say, "Whoa, you're crossing out what you were going to take. I'm putting down Becker." And then you hear, "Yeah, he hardly gives out any A's either," which was also true. Well, I don't know. And Becker doesn't assign a paper. Ooh, so I'm going to take Becker's class for sure, except that nobody assigns a paper in intro micro. So really that piece of information is irrelevant. But notice you're sort of shifting your opinion here on little tiny pieces of information. And my favorite is, of course, he doesn't assign a paper. Well, nobody assigns a paper in intro micro, not to my knowledge. So really that's nothing special, but it's all you've got. So you go with Becker, all right? Low confidence. Since our knowledge of the future is vague and scanty, levels of confidence are likely to be low. So forecasts are liable to change violently. All right, so we're going to get these sudden shifts, which I've already talked about, that you could change your mind very rapidly, especially when a market that had been going like this is going like that. Let's get the hell out of here while we can. So you were one of the ones buying and driving it up this way, but when it turns around, hey, I'm out of here. All right, so a very quick and violent change of opinion. I want to skip convention for a minute because it's complicated. Quick results. Keynes is of the opinion that people really found quick results very exciting. That making a money over the course of a year, whatever. But making it quick, people found that very exciting, particularly people attracted to the stock market. So in other words, we're going to want to buy and sell. We're going to want to make money off the capital gain, off the appreciation of the asset and sell it, rather than sit there and make money off the dividends. And then last, and you already know what this is from previous lecture, animal spirits. People have this sort of tendency towards action rather than inaction. And this can offset any misgivings we have about making important decisions. And of course, we've already talked about that. Okay, this one here is a little complicated. It's a very, very philosophical idea. Asset market participants assume that current prices must be an accurate reflection of the complete set of relevant information accessed and processed by the market as a whole. Stop. So you wake up in the morning and you see the opening price for Walmart, which was basically the closing price at the end of the day yesterday. His opinion was, as a market participant and as a statistician and as a mathematician and as an economist, that people tended to look at the opening price as correct, quote unquote, that this is an accurate reflection of everything that led up to this point in time. When in fact, that's logically impossible, because a complete set of the relevant information up to this point in history doesn't exist. We don't have a complete set. We don't know what Walmart's price really should be, because that uncertainty problem exists with respect to the past as well as the future. We don't know all the relevant factors. However, making that simplifying assumption helps, because we can treat today's price as correct and focus our attention on future changes. So what convention basically does is say that when you wake up in the morning and you see the new price, unless something new happens, that's the right price. Okay, so now we're going to get into some examples here, a little bit more into some examples so I can explain some of this. And let me see where I am in my notes. Oh, let me go ahead and do that for you. Here we go. Oh, no, next page. Yeah. Okay. Now, there are two features of financial markets, and of course we're talking about currency here, but they're closely related. Volatility and bandwagons, all right? And volatility is, the price is bouncing up and down, or having very large movements up, very large movement down. And there is some controversy within neoclassical economics, less so within financial economics, that such volatility really exists. Or if there is such volatility, well, then it's simply a result of the fundamentals changing a lot, which is very hard to justify. So, by the explanation we've just had, let me back up here. What we're leading up to is, how can you explain volatility with availability, representativeness, anchoring, the framing, the incentive to follow the crowd, uncertainty, low confidence, convention, quick results, and animal spirits? Is there a way we can explain it with those factors? And here I picked out 6 of them. And I'm going to read to you what it says in the book. This is what creates volatility. Uncertainty means that as events emerge, so agents, lacking the whole picture, are likely to overreact. Remember, they overweight individual pieces of information. And then I have something in parentheses. Representativeness works to reinforce this, as it encourages people to think they can make forecasts based on small samples. There was a big study done on that. And if the event that created the initial price movement was particularly dramatic, then availability will lead agents to overweight it. And once the volatility starts, anchoring may contribute as attention shifts from price levels to price changes. All right, so I'm going right down the list there. Throughout this process, agents' desire for quick results and the willingness to act even when lacking a firm basis for decision-making, that is, animal spirits, makes the emergence of sudden and violent price movements, if not a daily event, certainly not unexpected. Convention means that each time some new event occurs, agents feel bound to assume that further price changes are inevitably warranted. And again, it's explained further in the book. But here's the idea, that these factors here make it not surprising that we see these currency prices bouncing around. And I want to say a little bit more about this one right here. This is very interesting. Desire for quick results in animal spirits. One of the very first things I read when I first started at TCU and I was trying to figure out exchange rates was a document from one of the Federal Reserve banks, and it was from a speech given to a bunch of currency dealers by a Federal Reserve official. And the Federal Reserve official opens with something like, well, the Federal Reserve and Treasury have been able to maintain a stable currency market for the last 6 months. But of course, you don't like that, do you? And then parentheses, laughter. And here's the underlying lesson there. If you're a currency dealer and the price does this, how can you make any money? Price is going to do that and that. You're going to have increases and decreases in price to make money. If a stock price stays exactly the same for years and years and years, well, maybe you can get the dividend payments, but you're not making any big capital gain like you would like this. Currency dealers don't like stable markets. Stable markets don't have opportunities for profit. Volatile markets do. All right. So when things start bouncing around, like, hey, let's get in there and make some money. So anyway, as I said, I thought that was funny because it didn't explain it in the speech, but it was implied that the currency dealers didn't like the fact that the markets were very stable. All right, so there's volatility. The other one is bandwagons. There's a lot of controversy over this. Is it true that currency prices can rise or fall under their own momentum? That even when the reasons for the initial appreciation or depreciation, which could have been perfectly reasonable, were gone, currencies still move in the same direction for a while. And you will notice in the reporting on currency markets, dealers will talk about this. They will say that, well, we think it's still going up on bandwagon effect. That what's really happening is that people are still buying it because people are still buying it. And after all, think about this. Okay, you're a dealer, and the price is going like this, and you don't think there's a good reason for it. So, buy it. All right? Go ahead and buy it. All you got to do is jump ship before it goes too far down. All right? You don't care whether there's a good reason for it or not. If it's still going up, it's still going up. And if I buy here and sell here, I make money. In fact, if I buy here, sorry, and what I'm trying to show there is if I buy way down the bottom here and sell right after the turn, I've still made a bunch of money. All right? So it doesn't matter. So the currency market participants talk about this. And a particular exchange market event that I'll talk about a lot as the semester goes on was this big dollar run-up in the early 80s. And there was a lot of talk that once all the reasons for the big dollar run-up, which I mentioned in an earlier lecture, had to do with the high interest rates and the stock market going up in the U.S., once they had stopped and interest rates had caught up in other countries and we had cut ours back down, the dollar still went up for about 3 months. 3 to 6 months, it still continued. That's a bandwagon effect. Okay, so why would bandwagon effects exist? Why would people jump on the bandwagon? Why would people buy something simply because other people are buying it? I don't know. Let's find out. Here's from the book. As a price movement begins, it is a salient event. That means something that sticks out, and is therefore more available in memory. Agents may also be expected to anchor to that movement rather than contributing to the emerging trend. I want to say something else about that in just a minute too. Representativeness convinces agents there must be some reason for it. If event A is occurring, then there must surely be some process B behind it. So even if I don't understand why the price is going up, maybe there's a reason. That I'm small compared to the market. And so, let's see. And so, yeah, they assume they should be taking positions as implied by the price changes. Fourth, I made this one up myself. This is when I invented driving in the car one day. I thought, hey, I bet this happens. Of course, I have absolutely no evidence whatsoever that it's true. Fourth, as the price continues in the same direction, those forecasting the movement will be encouraged by the apparent substantiation of their predictions and become increasingly confident and willing to commit funds. So, you're not entirely sure why it's going up. You're buying and it's still going up. Well, hell, maybe I know what I'm doing. So, if you're forecasting the increase and it's still going up, then, hey, I know what the hell I'm doing. Finally, let me go back to this. You're better following the trend. If the price is going up, 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 there's a lot less to be lost by following the bandwagon than there is by pushing against it. And let's see, I said I was going to say something else about this. What was it? Oh, crap. Well, a couple of things. Let me see what I've got next. That's the end. All right. A couple of things. One is that big market booms tend to start from a single unique event. We'll talk about this when we get to financial crises. And then that single unique event is available in memory. It's because it's very dramatic. And then people start anchoring to the changes rather than to the levels. They figure that they're able to forecast despite the small sample size. As they continue to see the prices go up, which is consistent with their forecast, they become more confident. And what the hell, it's better to be right with a group of people than wrong. I'm sorry, better to be wrong with a group of people than right all by yourself. Because people just say you were lucky. And I think that's it for that. We just have a couple more things to go here for exam one. I do want to tell you something. I had to take a bunch of the readings out for COVID-19 semester. And one of the ones that really hurt to take out was by a guy named, here, I'll put the screen back up, by Thomas Oberlechner, who got his PhD at some place in Boston called Harvard in psychology. But guess what? He's really interested in exchange. Hello. He's really interested in exchange rates, or at least he used to be. He was a trader. But really interested in exchange rates. And so he did these fascinating psychological studies on currency dealers that I would love to do, but I don't have the background. I don't know how to do that kind of stuff. So, but they were fascinating, and I was assigning them in class, or at least some parts of them. And I want to tell you a couple of things he discovered. And I say he's a trader. I corresponded with him for a while because I was just so crazy about the stuff he was doing. I thought that was really fantastic. And now he's an administrator. He's like a dean. It's like, oh my God, somebody else could be a dean. But the combination of the background in psychology and the interest in exchange rates, I know of no one else who can do that. And he was really doing some fantastic stuff. But anyway, I guess he should live his life the way he wants to. Not for me. Okay, a couple of interesting things he found out. One of them was he was asking dealers, who is your main source of information when you're collecting data to make your forecast? And they said, oh, it's the financial press. When Reuters or Bloomberg or whomever comes out with information about the German economy or whatever. That was their number one source of information. And then he asked the financial reporters, when you're writing on currency markets, who's your number one source of information? And they said, oh, the currency dealers. He's like, uh-oh. So the dealers are getting their info from the reporters, and the reporters are getting their info from the dealers. Now, to some extent, that's quite reasonable, right? That makes sense. That's what you would do. Except that he said it sets up an unfortunate possibility, and that is that we've got a feedback loop there, wherein things that may start off as a rumor all of a sudden take on an air of fact because they said it. It's in the paper now, or not in the paper. It's on your computer screen. For example, a reporter calls you up and says, hey, I've been wanting somebody's view on the euro, and you're like, oh, well, that would be me then, wouldn't it? You're kind of flattered that somebody called you up for an opinion. Yes, that's an excellent question. What I believe will happen is so-and-so. So, your quote ends up in the paper, a quote that you made before you even had your morning coffee and really weren't sure what you were talking about, and now it's carried some weight. So anyway, he thought that was one of the means by which we can have these dramatic events and availability cause fluctuations in the currency price when really there was no dramatic event or important event whatsoever. The other thing I really thought was interesting in that particular piece was he also asked the dealers, what's the most important to you about the information you get that you're using to create your forecast? And accuracy of the information was either second or third. I can't remember now. The very most important thing was, I got it first. I need the information first, all right? Because the market's going to move in reaction to this information. And if it's already moved, it's too late. I've got to get in before it moves. So I want the information first. And in fact, it doesn't matter if it's accurate. I remember one morning, gosh, this was years ago now, Smith Hall wasn't there yet, and then you could park along the street right there. And our offices were in Dan Rogers back then. And so I'm pulling in the morning, and they're talking about the stock market, and somehow the currency market came up. And they said that the dollar fell this morning on rumors that President Bush had been shot. And then it went back up again after they found out it wasn't true. And first of all, the interviewer was asking the analyst, which was David Johnson, that's kind of weird, isn't it? He said, oh, no. He said, that kind of stuff happens all the time. He said, if President Reagan had been shot as many times as he'd been rumored to be shot on the floor of the stock market, he would have been riddled with bullets. And he actually was shot once. And so that wasn't unusual. And there was also a rumor that a Japanese company had started that rumor because they wanted to buy dollars. So they spread the word that, hey, I hear President Bush has been shot. And then the dollar falls and they buy it. I thought that was kind of neat. Not neat, it's actually a really bad thing to happen. But that they care more about getting the information first than they do about whether or not it's accurate. Because even if it's not accurate, the market's going to move. It was not accurate that President Bush had been shot, but the market moved. And so if I can get in there first before the information, then I can take advantage of how the market's going to move afterwards. He also had a really interesting piece that I used to assign in class where he would ask, one of the things he asked people, these dealers, was, how do you imagine the market? What metaphor are you using to associate with the market? And this is one of those places where, as a psychologist, he could do this, and I couldn't even begin to think about it. But they usually described the currency market as a competition. We're all fighting each other to, get the highest profits and so forth. And it really is an extremely dangerous market, because unlike the stock market, in the stock market, all the stocks can go up and we all win. But if the euro's going up, it's going up relative to something else. That always a currency is falling when a currency is rising, because they rise and fall relative to each other. So it's a much more dangerous market. But he said, if you listen to what they said, though, their other descriptions, they really felt like, see, is this right? they really felt like the market was almost a living being or like the ocean. And I liked the ocean one. So this was their explicit metaphor. This is what they said out loud. But he said, I think they said it because they thought they should say that. And perhaps that's on some level what they like to think they do. But they really acted as if the market was completely separate from them, and that it was so huge that they were powerless. That there are storms, and there are calm periods, and that they were just hoping that those storms weren't gonna swamp them. So anyway, stuff I had to cut out, unfortunately, in order to get this semester manageable. But if you're watching this in a different semester, you get to do that too. And oh crap! One more thing I just thought of as I did that. No, that's good. Okay, so yeah, now we're almost done. Yeah, cool. With exam 1.